What if I told you that one of the most decentralized blockchains on the planet earns about $20 per day in fees while paying out $233,000 per day in token incentives? That's not a typo. That's Polkadot right now in 2026. Price sits around $1.20. The token is down more than 99% from its all-time high. And yet, the engineering, the decentralization, the actual on-chain infrastructure is genuinely world-class. So today, we answer one question. Is DOT the most asymmetric setup of this cycle, or the most expensive lesson in value capture you'll ever pay tuition for? Polkadot is trading at the 120s on the weekly chart. That's a price you wouldn't have imagined seeing 2 years ago when Polkadot was trading at an unbelievable $12. The chart is bleeding, sentiment is broken, and the loudest voices on crypto Twitter are openly mocking the project. But here's where it gets interesting. The fundamentals, the real on-chain builder-side data, are telling a completely different story than the price. We have a freshly listed US spot ETF, a hard supply cap, a new application platform live on mainnet, and one of the highest decentralization metrics in the entire industry. So why is the chart dying? That is exactly what we are going to break down, starting with the catalysts everyone already forgot shipped. Let's start with what most channels will not cover honestly. On March 6th, 21 shares launched the first US spot Polkadot ETF on Nasdaq under the ticker TDOT. It was seeded with $11 million, and it carries a 0.3% management fee. That same month, Polkadot pushed through a tokenomics upgrade that introduced a hard cap on DOT issuance, a maximum supply of 2.1 billion. And on top of that, Polkadot Hub went live. This is the unified Layer 1 application platform that supports both EVM and the new RISC-V-based PVM. 3 structural catalysts in a single quarter. Now, here is the contrarian part you do not hear on most channels. After 52 days of trading, the cumulative net inflow into the spot ETF is $1.58 million. Not per day, total. The fund essentially flatlined right at its seed capital. There has been no marginal institutional bid. The narrative shipped, and the flow disaster shipped with it. The bulls will point to ecosystem growth, and they do have a point. Accurast just crossed 750 million on-chain transactions, powered by 250,000 devices across 175 countries. EnergyWeb is orchestrating real-world energy data across independent nodes, building decentralized infrastructure for grid-level emissions tracking and renewable validation. Polkadot just shipped an official documentation MCP server, which lets developers and AI agents query the entire docs library in real time. The builder ecosystem is alive, but here is the brutal counterargument. A crypto Twitter account named FinTechNX put it best, and I want to read this carefully. DOT holders get 0 revenue from parachain activity, 0 fees shared, 0 burns from usage. The token exists to secure a network that, by design, does not reward owning it. The post called it a beautiful cathedral that forgot to charge admission. And once you see it, you cannot unsee it. Look at the numbers. Polkadot's base layer has roughly 2,280 daily active users. It generates about $20 in fees over 24 hours, and it pays out $233,000 in token incentives over that same window. The fully diluted valuation sits around $2 billion. Monthly fee revenue across the entire base layer in April was $1,771. Not millions, dollars. Stablecoin supply on Asset Hub peaked above $230 million in late 2025, and it is now retraced to roughly $76 million. That is a 67% drawdown in productive capital. And in 2024 alone, the foundation spent over $87 million on private jet ads, Formula One sponsorships, football partnerships, KOLs, and conferences, while the network earned almost nothing back. We have not even mentioned the recent Hyperbridge exploit in April, where an attacker minted 1 billion DOT on Ethereum side and dumped it for around $237,000. Native DOT was technically unaffected, but the optics damage is permanent. Now here's the part that flips the entire narrative. Polkadot has a Nakamoto Coefficient of 178. That's the highest of any major chain. Ton sits at 76, Solana has 19, Base has 95 active core developers contributed code in the last 30 days, putting Polkadot fifth among all Layer 1s. 979 commits in the same window. The engineering is real. The decentralization is real. The product is real. What is missing is the mechanism that pays the holder. That is the entire bear thesis in a single sentence. Now let's translate all of that into price action. Incredibly, on the weekly chart, DOT is trading below $1.30. The macro structure is brutal. Price is below the 10 and 21 exponential moving averages and below the 200 simple moving average. Every trend filter on the higher time frame is bearish. But within that bearish structure, something interesting happened. From September of 2025, price was compressed inside a falling wedge, marked by the white dotted lines on the chart. The wedge was getting tighter every single week, and then we got the breakout to the upside, confirmed last week. The catch is this. Price is now using that broken wedge resistance as new support. If the previous resistance starts acting as a ceiling again, instead of a floor, the structural picture rolls right back over. That is the line I'm watching. Above current price, we have two key resistance zones based on the Fibonacci extension anchored from the June 2025 low at $3 to the September high of $4.88. The first level is the 2618 extension at $1.37. That zone aligns with the 10 EMA. Above that, we have the 21 EMA, then the 1618 extension at $2.23. Higher up, two descending trend lines still loom. One drawn from the December 2024 local top at $11, and the longer-term one from the all-time high near $55 back in 2021. On the downside, here is what concerns me. There are no horizontal supports left. We are at all-time lows. The only meaningful technical zone below current price is the 3618 extension at 85 cents. That's the next theoretical demand pocket if the wedge breakout fails. Below that, it is open air. The Heikin-Ashi Relative Strength Index is doing something worth pointing out. It's still in oversold territory, but it has come up from extreme oversold readings. It's pointing neutral now, and it has formed a clean bullish divergence with price action. Price made lower lows. The indicator made higher lows. That's the yellow arrows on the chart. There's also a descending trend line on the indicator itself. A break above that line is where momentum genuinely turns. Bitcoin is the macro overlay for everything we just discussed. On the daily chart, Bitcoin is sitting around $75,000 to $76,000, working inside an ascending channel marked by the white dotted lines. Bitcoin just broke a major descending trend line to the upside, with the 21, 55, and 100 EMAs acting as dynamic support below. There's a fair value gap and a CME gap above price, marked in green, and a major demand zone below in red. Bitcoin looks coiled to retest that broken trend line before potentially hunting the 200 SMA above. Until Bitcoin commits to a direction, every altcoin, including DOT, simply chops inside its shadow. So how am I positioning? I'm not buying here. I'm not selling either. I have been dollar cost averaging, with strategic accumulation around $4, $2.50, and most recently $1.50. It's a small portion of my total portfolio. Some of it is profit from prior cycles that I held believing a better future would arrive. That future has not arrived for DOT holders, at least not yet. De-risking at all-time lows into a confirmed wedge breakout with bullish RSI divergence is mathematically the wrong move from a probability standpoint. I'm waiting for an overbought signal on the weekly to reassess. My take-profit ladder is plotted on the chart in green circles. $2.20, $3, $3.60, $4.80, $7.50, and $11. The trailing stop logic is simple. First target hits, invalidation moves to entry. Second target hits, the stop trails up to the first target, and so on. We compound capital protection at every level. We let winners run while systematically removing risk from the table. So in my opinion, Polkadot is a contradiction. The infrastructure is among the best in the industry. The token is among the worst at capturing the value that infrastructure creates. The chart is at all-time lows. The wedge has broken to the upside, and the next move depends entirely on whether broken resistance now holds as support. If this breakdown was useful, drop a like, hit subscribe, and turn notifications on so you don't miss the next update. For those of you who want my real-time portfolio tracking, my exact buy and sell zones, the weekly live strategy calls, the Sunday prep report, and direct access to me, the Pro Capital Vault is open through YouTube membership. Just hit join below the video, scan the QR code on screen, or use the link in the pinned comment. Once you are in, sync your YouTube account to Discord, and every private channel unlocks automatically. This is for serious position traders who want to see exactly how I execute, not just what I think. If you missed my last Polkadot deep dive, watch it next. Each DOT video continues the previous one, and the full thesis only makes sense in sequence. None of this is financial advice. Always do your own work, protect your capital first. Much love, I will see you in the next one.